You sold your home, now what? Am I responsible for any sales tax on the property? What is capital gain? Your home is likely your life's biggest and proudest purchase. All the painstaking measures you took, countless property searches, contract negotiations, inspections, and closing, to arrive at the dreams of your home ownership. Now it's time to sell. What's next? Hi, I am Darlene Medranda, a realtor with eXp Realty. For your convenience, también hablo español. Today, I would like to talk about a tax liability on the sale of a house called capital gain tax. This is something many sellers are not aware of. Most sellers think after they sell their home, they collect a check and move on. Did you know that your home is considered a capital asset subject to capital gain tax? If your home appreciated in value, you could be required to pay taxes on the profit. However, thanks to the Tax Relief Act of 1997, most homeowners are exempt. A capital gain might be short-term, 1 year or less, or long-term, more than 1 year, and must be claimed on income taxes. You can sell your primary residence and be exempt from capital gains tax on the first $250,000 if you are single, and $500,000 if married filing jointly. This exemption is only allowable once every 2 years. You can add your cost basis and cost of any improvements you made to the home to the $250,000 if single, or the $250,000 if married. How much is the capital gains tax on the real estate? To be exempt, the home must be considered a primary residency based on the Internal Revenue Service rules, or IRS. These rules state that you must have occupied the residence for at least 2 years of the last 5 years. If you buy a home and a dramatic rise in value causes you to sell it a year later, you will be required to pay capital gains tax because you will be considered a short term. If you own your home for at least 2 years and meet the primary residence rules, you might owe tax on the profit if it exceeds IRS thresholds. Single persons can exclude up to $250,000 of the gain, and married persons filing a joint return can exclude up to $250,000 of the gain. Short-term capital gains are taxes as ordinary income with rates as high as 37% for high-income earners. Long-term capital gains tax rates are 0%, 15%, or 20%, with rates applied according to the income and tax filing status. This rule even allows you to convert a rental property into a primary residence because the 2-year residency requirement does not need to be fulfilled in consecutive years. Suppose you purchase a condo for $300,000. You live in it for the first year, rent the home for the next 3 years, and then when the tenants move out, you move in for another year. After 5 years, you sell the condo for $450,000. No capital gain tax is due because the profit from the $450,000 was the sale price minus the $300,000, which was the purchase price, equals $150,000. Does not exceed exclusion amount. Consider an alternative ending in which home values in your area increase exponentially. In this scenario, you will sell the condo for $600,000. Capital gains tax is due on $50,000, and that is from the $300,000 profit minus the $250,000 IRS exclusion. If your income falls between $80,000 and $441,450, your capital gain tax rate as a single person is 15%. This is a table with the long-term capital gain tax based on the filing status. The other major restriction is that you can only benefit from this exemption once every 2 years. Therefore, if you have 2 homes and lived in both of them for at least 2 of the last 5 years, you won't be able to sell both of them tax-free. It's best to consult a tax professional before selling a property and to check for any changes on the tax code. If you meet the eligibility requirements of the IRS, you will be able to sell the home capital gains tax-free. However, there are exemptions to the eligibility requirements, which are outlined on the IRS website. When is a home sale fully taxable? Not everyone can take advantage of the capital gains exclusions. Gains from a home sale are fully taxable when the home is not the seller's principal residence. The property was acquired through a 1031 exchange, within 5 years. If you need to know more about the 1031 exchange, please consult a tax professional. The seller is subject to expatriate taxes. The property was not owned and used as the seller's principal residence for at least 2 of the last 5 years prior to the sale, and the seller sold another home within 2 years from the date of the sale and used the capital gains exclusion for that sale. Consider the following example. Mary and George, a married couple, purchased a home for $600,000 in 2016. Their neighborhood experienced a tremendous growth and home values increased significantly. Seeing an opportunity to reap the rewards of this surge in home prices, they sold their home in 2021 for $1.2 million. The capital gains from the sale were $600,000. As married couple filing jointly, they were able to exclude $500,000 of the capital gains, leaving $100,000 subject to the capital gains tax. Their combined income places them in the 20% tax bracket. Therefore, their capital gains tax was $20,000. This video is for information only. If you are thinking on selling a house and have questions about capital gain tax, please talk to a tax professional for any clarifications. If you like this video and found the information useful, please share it, like it, and comment and subscribe to the channel. I make weekly videos about real estate and our beautiful Long Island community. If you are thinking on buying or selling, don't forget to download your free ebook for sellers and buyers below in the description of this video. And remember, when you do what you love, people love what you do. Thank you, and I will talk to you soon.